Hello and welcome back. In this lesson we will continue with the value-added tax. Previously whatever we have been studying that was relevant to both F6 and P6. So this lesson is only relevant to P6. So whatever you will be studying in this lecture you haven't seen that before. So even if you have passed F6, this knowledge which we will study now, this is absolutely new, so you haven't seen this knowledge before. So whenever I tell you that this lecture is the old knowledge, so you have already seen it before, so what I mean to say is that this is just a refreshing knowledge. But when I say that this is new knowledge, so whatever we are studying in this lecture is absolutely new to you as far as P6 is concerned, that means I am enforcing you to watch the lecture with full concentration, because examiner knows as well that this stuff is new at this paper, so he's more likely examines new stuff because he has already examined and you have already passed F6. So in most of the cases he does not examine that stuff in details, whereas this stuff, because it is new, so definitely he is going to examine in details. So we will look at a couple of schemes, a couple of new rules in this lecture, and this lecture is hopefully a last lecture of value-added tax. Now when we talk about value-added tax, there are two types of value-added taxes. One is output tax, another one is input tax. If we just look at the input tax, then input tax is the tax which we pay on the purchases. Whenever you purchase something, you have to pay value-added tax on that. All right, so you are not paying directly to HMRC, you are paying to the vendor, you are paying to you are paying to the seller, whoever is selling you the stuff, you are paying to them, right? But what you do is you make a statement whereby you write output tax, then you write down the input tax, and whatever the balance is, you have to either pay to HMRC or you have to recover it, right? But there are some assets, there are a couple of assets on which when you buy them, you have to pay value-added tax, right? That happens in every case. But in them couple of assets which we will see now, when you buy them assets, you pay value-added tax, but you cannot recover it straight away. Like in other cases, whatever you buy, you pay value-added tax on that, but you can recover it at the end of the year. However, there are two exceptions. There are a couple of assets. When you buy them and when you have bought them, you have paid value-added tax on that, but you cannot recover that straight away in the first year. So you will have to recover it either in 5 years or 10 years. So this is the rule. And this scheme is called capital goods scheme. Right? Now we will look at the capital goods scheme. Now what are them assets which we have to buy and we have to pay tax, but we cannot recover the value tax straight away? The first thing is computers. When you buy computers, you cannot recover the value tax straight away. And the second thing is land and building. So when you buy some building on a piece of land, you cannot recover the value of the tax straight away. So you will have to wait for 5 years or 10 years for computers and land and building. So it's 5 years for computers, and for land and building it is 10 years. There is some limit as well as far as value is concerned. So for example, if you buy a personal computer, which will be only costing you 500 quid, so when you buy for £500, it is not that computer. So the computer which we are talking about is a huge computer which is used in big companies or software firms or something like that. So because they are very, very expensive computers, like servers of big, very, very massive sites like Facebook server. So what do you think? The Facebook has billions of users all over the world. What computers do they have which is managing the data of that many users? Obviously they got big server machines which cost thousands of pounds, right? So we're talking about expensive computers, about £50,000 or more than that, right? So let's look at the capital goods scheme then. I will just share the screen with you, and we will look at capital goods scheme, which is our topic area in this lecture. I've already shared the screen with you, as you can see on your screen, page 90. I'll just go down on the page and we'll look at the capital goods scheme. Here you go, as you can see on your screen, that is capital goods scheme. Now it says capital goods scheme applies to computers costing £50,000 or more. As I said, these are special computers, so it costs £50,000 or more, which are dealt with over 5 VAT years. So you can recover the VAT in 5 years. And land and building costing £250,000 or more, which are dealt with over 10 VAT years. So if land and building costing £250,000 or less than that, so for example, if you bought a building and which costed less than £250,000, then capital goods scheme won't apply. However, if you bought a piece of land or building which is costing £250,000 or more than that, then this scheme will apply. Same applies to computers as well. So if you bought more than or equal to £50,000, then this scheme will apply. Otherwise, you will just you will do the normal calculation of value-added tax. All right. Now, what is the calculation? It says how you can recover the VAT in the first year. You can recover input VAT. Recoverable is cost of purchase. Now, say for example, in case of computer, you bought it for £50,000, and you will recover it £50,000 multiplied by 20%, which is our VAT rate, multiplied by the usage in first year. Now, what does usage mean? Usage means business usage. Now, when you buy a computer, you might be using it for business purposes. Some of it you are using in first year. So, say for example, if you bought a computer in the first year, you was using it 60%. However, in the second year, you use it more than what you have used in previous year. So, in first year, you have used it for 60%, and in the second year, you've used it for 80%. In the third year, you have used it for 85%. So it might be increasing or it might be decreasing as well. Say, for example, after third year, in the fourth year, you have used it for just 60%. So it will either be increasing or decreasing every year. So it will depend on how much are you using. So it depends on the percentage of usage and how you can calculate the value of tax. So in the first year, you will take the cost of purchase multiplied by 20%, which is standard rate of VAT. So cost of purchase, which is in our case, as I said, it is computer, then it will be about £50,000. So if assuming the cost of purchase was £50,000 multiplied by 20%, multiplied by the percentage used in first year. Assuming percentage of use in the first year was 60%, so we'll take 60% of that, and that would be our recoverable input VAT in first year. Now the same treatment will apply on the same asset in subsequent years as well. Now how would this apply? In subsequent years, we'll take input VAT recoverable or payable. How can we do that? Cost of purchase multiplied by 20%, just the way we did before, multiplied by the percentage of use in first year less percentage of use in that year. Say for example, in the second year, in the first year was 60%, in the second year was 80%. Excuse me, so we have increased the usage, so it will be 20%. Multiplied by 1/5 for the computers and 1/10 for the land and building. Alright? Now if you sell that same asset in the year of sale, how can you do that? Input VAT recoverable or payable. In order to calculate that, what we have to do is we have to take the cost of purchase multiplied by 20% multiplied by 100%. Now because it is the year of sale, so that's why we're taking it 100% less highest percentage of use in any year. Say for example, in year 1 was 60%, in year 2 was 70%, and in the maximum we have used it for 95%, so we'll deduct the 95% from here. Alright? And then we'll take multiplied by the remaining years, whatever the remaining years were out of 5, divided by 5 for the computers, or if it is land and building, so we'll divide it by 10. Alright? So that is a capital goods scheme. Now, we'll just do a question together. As I will just go on to the question, that is BPP Exam Kit. I've just picked a question out of the BPP Exam Kit. Yeah, I think it is question 22. It is. Alright, so we will do a little part which is only relevant to capital goods scheme from here, where it says Madison Limited. Alright, so let's read the question. It says Madison Limited purchased a building for £400,000. As you can see, he has bought a building which is costing more than £250,000. So what we will have to do, we'll have to apply the capital goods scheme on that. all right, because it is costing more than £250,000 and it is land and building. So it is building in this case. Plus 20% value tax, and machinery he has bought machinery for £300,000. Have we studied any rule for machinery? Any rule relating to machinery for capital goods scheme? No, we haven't actually. We have just studied for land and building and computer. So capital goods scheme won't apply for machinery, I think. As it says here, they have bought machinery for £300,000 plus VAT and began to trade on 1st of October 2016. Now, medicine is partially exempt for purposes of VAT. In the year of 30th September 2017, its VAT recovery percentage is expected to be 80%. Now, his VAT recovery percentage was 80%, so he's using 80% in the first year, as it says here. However, I expect this percentage to fall slightly in the future years. As it says in the question, he's expecting the percentage to fall in the future years, so the percentage will reduce in the following years. Let's go to bottom of the question and read the requirement. It says part C here, Madison Limited, recovery of input tax. Explain how much of the input tax in respect of the purchase of building and machinery can be recovered by Madison Limited in the year ended 30th September 2017, and how this may be adjusted in the future years. Now he's asking how much we can recover in this year and how it may be adjusted in the future years. All right. Include an example of a possible adjustment in the year ending 30th September 2018. He is asking us to include an example as well for the next year where the percentage will be reduced. So we'll make up an example. So in this year it is 80% usage. So we'll take an example of say 70% because it is reducing. So we'll have to take the reduced percentage. So in this year it is mentioned in the question. In this year the percentage was 80%, but he's expecting it to reduce in the future year. So we will assume that 70% or 60% or whatever. So we'll assume that in the future years it would be 70%. So we'll do that. All right, and in the requirement it says Madison Limited recovery of input VAT 4 marks. Now this is worth 4 marks and it is very, very easy. Now we'll just we'll just read the notes. I assume you've already downloaded the notes. Now please look at the notes if you have already downloaded, because I cannot share the notes with you as we will look at the question from here. Now it says on the notes, if you see, I'm looking at the notes now. In the first year, now we are in the first year, how can we recover it? We'll have to take input VAT recoverable. How to calculate input VAT recoverable? We'll take the cost of the purchase. Now how much was the cost of purchase? We'll have to go a little in the start of the question. It says £400,000. Now the cost of the building is £400,000. So we'll have to multiply it by 20%. So £400,000 multiplied by 20%. Multiplied by the use in the first year. Percentage use is how much? Percentage of use in the first year is 80%, it says in the question. So we'll take £400,000 multiplied by 20% multiplied by 80% because it is 80% in that year. Now as it says in the question that in the future years it is expected to fall. So we will have to take the subsequent years. Now look at the notes. It says in subsequent years. How can we do that? We'll take cost of purchase. We'll take again £400,000 multiplied by 20%, multiplied by the percentage used in the first year. The first year was 80%, and less percentage used in that year. Now in the second year we are just assuming, because in the question it says just make up a figure and just tell me the answer. So we'll make up the figure. So in the second year we assume it would be 70% or 60%, whatever. So 80% minus 60%, as it says in the notes, multiplied by what is it? It is computer or what? It is building. So we'll take multiplied by 1/10. All right. So we'll do 1/10 for that because it is land and building. It is not computer. If it would have been computer, we would have multiplied by 1 and divided by 5. Now because it is building, so that's why we'll do multiplied by 1 divided by 10. Alright, so whatever the answer will be, that will be our answer for subsequent years. Alright, so that was it. We just had to do just this bit and everything else was same. Now as far as the other bit was concerned, machinery, So machinery capital goods scheme won't apply for machinery. So we will be able to just take £300,000 and percentage used is 80%. So £300,000 multiplied by 20% multiplied by 80%. So that would be the amount that would be recoverable in that year, and there won't be any adjustment for future years because capital goods scheme won't apply for this machinery. All right. So that was our question number 28, part C. Now, if you want to do it later, please note down it is question 28, part C. Now let's go back to the answers as well. So just to make sure if we did it right, that is the answer. I've already opened it. So it is recovery of value tax on assets acquired by Madison Limited, part C. Now on the building it says capital goods scheme will apply on the building because it costs more than £250,000. Madison will be able to recover 400,000 multiplied by 20% is equal to £80,000 multiplied by the percentage used in this year is 80%. So take £64,000 on the building in the year 30th September 2017. Now for each subsequent years during the recovery of 10 years, an adjustment will be made to the VAT recovery. The adjustment is equal to the difference in the percentage used between the first year and the year under review, multiplied by 1/10 because it is building, multiplied by the original input tax. Now for example, if the percentage in the year to 30th September was 75%, now he has taken as 75%, whereas in my example I told you we take 70%. So whichever you take, because it is reducing, it is just assumed figure. So even if you would have done with 70%, that is fine. So 80% minus 75%, which is 5%, multiplied by 1/10 multiplied by £80,000. So that is the amount, £400. That is the amount which we will have to pay to HMRC. Now why will we have to pay to HMRC? Because we have overtook. So we have been paid more than what we should have been paid for input tax. So in the first year it was 80%. So we recovered the 80%. Whereas in the second year it was 75%. So we will have to pay back 5% of that. Now say for example in the third year, if it is increased from 75 to 90%, so whatever the 90% and 75%, whatever the difference is, say for example 15%, so we'll have to take 15% and we will go to HMRC and we will take our money back and HMRC will pay us back. Alright? And it says machinery, for machinery, capital goods scheme does not apply for the machinery. Madison will be able to recover 20% multiplied by 80% of £300,000, which is £40,000, £48,000 on the machinery in the year ended 30 September 2017, and there will be no adjustment in the later years. Alright, so that is our end of our question. Now let's go back to our notes. Right then. Now I'll just go a little on the start of the page. It is page 90. The second thing which we have to start is partially exempt partially exemption and input VAT. Now what happens is that we know that if you are registered for value-added tax, if you're making taxable supplies and you are registered, you can recover the value-added tax on the taxable supplies. Now if you are selling exempt supplies, you cannot recover value-added tax. So if you're making taxable supplies, so if you're selling taxable stuff, you can recover value-added tax if you buy something. When you are selling exempt supplies, or if you buy exempt supplies, then you won't be able to recover any value-added tax on that. Now say for example, if you go and buy from the market any stuff which is taxable supply, then you pay value-added tax on that and you can recover it from HMRC as well. When you buy some stuff which is exempt, then you won't be able to recover any value-added tax. Now the people could be partially exempt as well. Now they could be making taxable supplies as well as exempt supplies. Now in that case what happens is, how can we recover the value-added tax? That is questionable. Excuse me. Now that is our subject area today, the second subject area of now. It is partially exempt individuals. Now we'll just read from the notes, and as you can see on your screen, it says partial exemption and input VAT. Where a person makes a mixture of taxable and exempt supplies, he is partially exempt, and not all of his input tax is recoverable. So his all income tax won't be recoverable because he is partially exempt, and not his all input VAT is recoverable because some of his attributable to exempt supplies. Now when he's making taxable supplies and exempt supplies, mixed supplies, then all of his input VAT won't be recoverable because he's making both supplies. He's making exempt supplies as well. For a trader who is partially exempt, input tax must be apportioned between that relating to taxable supplies which are recoverable and relating to exempt supplies which is not recoverable. The standard method of attributing input tax is as follows. Now when you're making standard supplies, then you can recover the input VAT. When you're making exempt supplies, then you cannot recover it. When you're making mixed supplies, then we'll have to identify which are taxable, which are exempt. Now the one on which are taxable, we can recover the tax on that. One which are non-exempt, we cannot recover input tax on that. Now, how can we do that? It says it tells us 3 steps. Now, step 1, it says calculate how much of the input tax relates to making taxable supplies, and input tax will be recoverable on that. So one which is so it says we'll have to identify the taxable supplies. So input VAT on that will be recoverable in full. Calculate how much of the input tax relates to the exempt supplies, and that would be exempt and it would not be recoverable. And calculate how much of any residue input tax is recoverable using the percentage. Now if whatever the remaining one is, there is a formula to calculate it. Now how can we do it? We'll have to take taxable turnover. So we'll have to take taxable supplies over total supplies. Now total supplies means taxable plus exempt, multiplied by the percentage, and whatever the percentage is, we'll have to round it up. Now how can we round it up? It tells us below. Where the residual input tax does not exceed £400,000, the figure is rounded up to the nearest whole percentage. Otherwise, the figure is rounded to the 2 decimal places. Now, where the input VAT wholly attributable to exempt supplies plus the residue VAT attributable to exempt supplies, so whatever the total of exempt input VAT is, fulfills one of the following tests, then all input tax would be recoverable. Now these tests, test number 1, 2 and 3. Now we will do a question together in order to see if we can understand this or not. But for now we are just reading it. But when we do the question together on the board, then you will understand this rule better. Now let's read first. Test 1 says total input VAT is. Now what are the conditions? Now if these 3 conditions, test 1, 2 or 3. Now if any of this condition is fulfilled, then all the VAT would be recoverable, even if it is taxable supplies or even if it is exempt, because VAT on value-added tax on taxable supplies are recoverable anyway. But we are working for the exempt supplies. So whatever the input VAT is on exempt supplies, we are worrying about that. Now, if any of the following conditions has been satisfied, then we can recover not only the VAT we have paid on taxable supplies, but we can also recover the value-added tax on exempt supplies. So what are the tests? The first test says total input VAT is £625 or less than a month on average, and value of exempt supplies is 50%. Hang on, I have forgot to move down. And the value of exempt supplies is 50% or less than the total supplies. In the test 2, it says total input VAT less input VAT directly attributable to taxable supplies is £625 or less a month on average, and value of exempt supplies is 50% or less than of total supplies. And the third test says input VAT wholly attributable to exempt supplies plus the residue VAT attributable to exempt supplies. So whatever the total exempt supplies are, exempt input VAT is £625 or less than on average, and it is 50% or less. 50% or less than or total less than of total input VAT. All right. Now please make sure what you have to do is please make sure you write down these 3 rules on your notebook now. Please pause the video because all of them rules are, I think, on the screen. Yeah, they are on the screen now. As you can see on your screen, please pause the video and write down these 3 rules, because I'm just winding up the lecture here, and we will do in the next lecture. We will do the question which I've already shared on the screen. Which I've already shared with you on the board. Now we will do the question together in the next lecture. we'll do this question, as you can see on the board. We'll do this question in the next lecture together. But for now, please make sure you write down these 3 tests, test 1, 2 and 3, because these are the tests which we will use in the next lecture, and I won't be sharing the notes with you because we will just concentrate on the board. Please make sure you note down these 3 tests. You won't understand it now, but when we'll do the question, then you would understand it better, alright? So that's it for this portion of the lecture. This lecture is continued in the next video, so please stay online, and we will do this question in the next video. Alright, that's it for now, and I'll see you in the next video. Thank you and goodbye.